Now let's move our attentions over to consumer sentiment. So if we're gainfully employed, what does it mean for in terms of how we're feeling about the broader economy and so forth? And we saw in the Westpac Corporation and Melbourne Institute data that the sentiment index fell by 2.4% to a reading of 82.4 points in April. Now that's a slide from the second consecutive month as persistent inflation and high interest rates continue to weigh on us. Before the latest inflation data, so this reading was before the latest inflation data, so there might be even a further spook that we might get in terms of what the results look like when we get the data out this month as well. Mm-hmm. Now the index has fell below 100 for over 2 years, and this is the longest since the early 1990s recession, indicating that there is very persistent, and pessimism heavily outweighing optimism at the moment. So it is an interesting story. And then when we take a look at those sub-indexes on the graph there's a couple that I've, sort of just asterisks. The first one is family finances over the next 12 months. So you can see there that's gone back another negative 1.5 over the course of the month to month, and then over the 12 months it's sitting at 10%. So there really is a struggle going on there in terms of time to buy a major household item. You can see the long-term average at say 124, and we're seeing that now currently sitting at 84.2. So that's gone down negative 2.9%. Time to buy a dwelling, a long-term average is 120.8. We're seeing that sitting at 77.8. Now that has moved up, and we expect that had everything to do with people thinking that there was going to be interest rate cuts. And so they're getting in before the crowds get in, given the shortage of supply. So we did see that coming through as well. Unemployment expectations index. This is the interesting one. People aren't worried about their jobs. Yeah. Like long-term average is 129. It's currently sitting at 128.1. So, and that's up 1% in that time. So they're just not so worried about that. And then in terms of house price expectations index, interestingly enough, long-term average 126.5. That's sitting at 161. Like that's extraordinary. So everyone just thinks that house prices just keep going up and up and up and up, right? Look, that's the behaviour that we do see out in the field as well, right? Where people are buying with their hearts, not necessarily with their heads, and we're seeing a bit of that happen as well. So I think at some point there, that's going to have to work itself out in terms of whatever market it is, where it's the entry price point market, the mid-tier markets, or the upper end of the market. It's just quite fascinating in terms of how the perception out there that the property prices only go up and never go down.
Yeah, and the disconnect also that I love to highlight in this table, which you've done beautifully, is the family finances and also the economic conditions. This is the same people that are forecasting that it's going to go backwards. It's an absolute dire situation, but their unemployment expectations are rapidly higher than they should be. Because if you've got to worry about the economic conditions for the next 12 months, normally you'd be worried about your job, because part of the economic conditions getting worse would mean higher unemployment, and therefore you'd be nervous about your job. But we're not. This is the disconnect that the consumer has. This is a perfect explainer of the entire discussion we've just had through the last hour. Is that this is why the household is so interesting, because they're worried about their family finances and the economics, but have absolutely no concern that they're going to lose their job. Zero. And that's so strange, because it's not how we should be thinking or feeling. And it partly explains, again, our behavior, as you said, out in the real world. We're not worried we're going to lose our jobs. So we just keep spending, despite the fact that we know that things are having a cost of living crisis and that spending is supposed to be reined in, and that we've got a problem around interest rates. It's not marrying up with our behavior because we don't have that fear of losing our job.
Yeah, and then the recency bias in terms of looking at that house price expectation.
Yeah.
That is a classic case of, well, I see it on the news and all I hear, we have this love affair with property, and it definitely builds that momentum in terms of higher prices over the longer period of time. So really, really good, interesting data. Let's see how that then correlates into the consumer spending story. And we saw, this has been the one that I've been on for pretty much 12 months to sort of say we've got to slow the consumer down. But at this particular case, we're also now really, I think we're going to start talking about this over the next few months when we do these updates. We've got to slow the government spending down. Now they're the problem in terms of spending too much. And I think there's, we'll see in a chart shortly in terms of the spread of who's spending what and the bubbles that we all live in terms of whether we're doing our bit in terms of helping with getting inflation down. But let's have a look at what the ABS data suggested around retail sales. So retail sales dropped by another 0.4 of 1% month on month in March, and that missed the estimates of a 0.2 growth. So that's a good story in terms of the downwardly revised figure from February. This is also the first decline in retail sales since last December, as turnover fell in these industries. So let's quickly go through them. Clothing and footwear, negative 4.3% versus 4.9% in February. Department stores, negative 1.6 versus 2.3. Household goods, negative 1.4 versus negative 1. Other retailing, negative 0.3 of 1% versus negative 6. Cafes, restaurants and takeaway food, negative 0.2 versus plus 0.4 in February. By contrast, food retailing rose by 0.9, a reversal from the fall of 0.2 previously. And throughout the year, we've seen retail sales grew by 0.8, which is the least since August of 2021. So remembering, greater population, we've talked about this many, many times. This is the sum of all of the moving parts. More employers, more population. Retail sales should be going up consistently all the time, but they're definitely below trend. And it's really clear in terms of people are being more conscious about where their spending is, but there's still more to do here.
Yeah, and I'd agree. I would, though, the final thing I would highlight, this is almost a perfect mirror image of the US 6 months ago.
Yeah.
So if you have a look at what happened in October and November last year, and January this year, they had 2 months of negative numbers, exactly the same and almost at the same scale as this. So does that mean we're going to get a pop-up in April and a pop-up in May? Possible. I'm not sure it'll be that dramatic considering where we sit, but you highlighted straight out there, Ben, government spending. We do have, obviously, the federal budget next Tuesday. That will be a telling story about this figure as well, because clearly part of the idea that if the government is going to come slightly to our rescue and provide us with cost of living assistance, spending can happen again. So watch that space as well.
Which means inflation will stay higher for longer because businesses won't have to make the tough decisions that they need to do. Now, let's look at the next chart. And I love this. Thank you to the CBA for sharing this data. But we can see the households that are doing it the toughest, right? So we can see there's, 25 to 29-year-olds, higher rents or higher mortgage costs, 30 to 34-year-olds also running families, 35 to 39-year-olds, significant, and, 40 to 44-year-olds. So there's this cluster that we're seeing here that, they've got all of these additional costs, education, mortgages, running their families, transportation, all of those are bedding into lower spending in those areas. Now, the flip side of that is all the retirees who are getting access to their cash. They've got lump sum super access. They're usually debt-free in terms of the mortgages they have. And so they've got money sitting in term deposits. They're getting dividend payments. They're spending and they're just living the life, and obviously COVID locked them down for a couple of years. So they're back on the spending treadmill. And so they, along with the government, are doing some of the hard, or negative work compared to what the RBA is trying to do from a monetary policy point of view to try and slow things down. So it really is, a complete dichotomy in terms of what's happening with that younger generation and their impact on spending versus obviously that older generation who are basically flush with cash.
Mm-hmm. And it's what we keep hearing at the moment is the argument around what we've just gone through, what we've seen from the RBA is the impact of monetary policy as it once was to now is clearly different. As Ben's spoken to you many, many times on all of his different forums, we do have a third that have a mortgage, a third that rent, and a third that own their property outright. And if you've got that larger population that aren't really impacted by tightening rates because they don't have exposure to some form of lending, then away they can go. Not only that, as Ben also just highlighted, they're more likely to be the creditors. They're not the debitors. They're the ones that are actually giving the banks the money through term deposits and the like. So every time rates go up, they get more money because they obviously get more money from the bank or from whatever institution they're invested in. So this is the catch that also has been highlighted right now, is monetary policy as effective as it once was? The argument is yes. It's just much more disproportional than it used to be. And that is what the problem is right now. And again, the fight that will be between the generations for millennia to come, I understand that. But it is becoming more acute than usual, that the difference between the older and the younger is larger, not because of necessarily wealth generational issues, but because of their different stages of life and their different exposures to the economic mechanisms that we all have.
And then there's obviously, the one that I also missed in that conversation is the downsizers who are cashing in on their
Yeah.
principal place of residence home, paying no capital gains tax, and another way of getting flush with cash. And there's 25% of most purchases are paid in cash, and they've got extra hundreds of thousands of dollars that they can either push through their super or basically get out there and buy their caravan four-wheel drive and get going
Yep.
in terms of how the world looks. So it very much is an interesting story in terms of, a lovely place for the wealth creation that's occurred for that generation, those baby boomers. There's no doubt that they've helped this nation become super prosperous and also very, economically relevant in terms of, the living standards and prosperity that this nation's enjoyed pretty much over the last 50 years as they've grown and now are hitting the retirement sort of circuit. So that is an interesting story, and I think there's more to be said in that particular thing, as well as obviously the wealth transfer that we know is going to happen over the course of the next 5 to 10 years. Now, let's do a quick snapshot on the business data before we move into the property story. We saw that the National Australia Bank, the NAB Business Confidence Index, was up to a reading of 1 in March from a flat reading or 0 reading in February. Figures stayed below its long-run average, with sentiment mainly improving in retail, construction and transport. Meanwhile, business conditions were little changed, a reading of 9 versus 10 in February, as sales at 14 and employment at 6 were steady, while profitability fell to a reading of 6 versus 10. So there is tension on price here, and so they want to pass on these costs. So we've got to basically not allow them to do that by not buying their goods and be really careful about our spending decisions. Forward orders were also negative at negative 0.1 versus negative 0.3. Capacity utilisation eased slightly at 83.2% versus 83.4%. Labour cost growth dipped to a reading of 1.6% in the quarter, equivalent terms of a prior 2%. Purchase cost growth slowed to a reading of 1.4 from 1.8. Retail price growth edged down to 1.3% from 1.4. Now, Alan Oster, I really enjoy his commentary, but he's the chief economist of NAB, and he said cost pressures remain elevated, but have eased a little more, but retail price growth remains elevated again. So he's got this whole combination, cost elevation moving through to growth remains elevated. He went on to say, fundamentally, this aligns with our expectations that progress on bringing inflation back to target will be gradual because obviously, the activity and the confidence that the business sector has. So some interesting data there to look at also, isn't there, Evan?
Yeah, and I'm not going to add much more to what Alan said because it perfectly sums it up that at the moment, the consumer, whoever the business is selling to, whether it's a good or a service, is still willing to take that price.
Yeah.
So they're not having to discount. And until that, in my view, changes, and that's what Alan's alluding to there, then we're going to have this problem around this gradual, longer term, slow burn to getting inflation back to target.